So without any further ado, I want you to give a warm welcome to Mark Howard, coming back as an Empower Series speaker today.
Thanks, man. Appreciate it, appreciate it. Well, we have a intimate crowd today, so I'm expecting lots of audience participation. Are we all okay with that? Show of hands, we're okay with that? Yes? All right, so as Clifton mentioned, September is Life Insurance Awareness Month. You might see the acronym LIAM. That's what that stands for, Life Insurance Awareness Month. And so we're here to talk to you about all things death. Fun topic, right? Right? Yes. No. This is really all about love and how you can help take care of those who you love in your family and those that you want to take care of in this unlikely event and unfortunate event that you can't. So I want to jump in and, oh, come on, technology. So just want to welcome, I always like to put up a happy slide. This is a recent event. My niece got married, showing my family there, all happy. This is part of my why on why I do what I do, to help protect families just like mine in case of an unfortunate event where you lose a loved one. You might notice that my father's not in here. He passed away of cancer at the young age of 68. And I'll talk a little bit about him and how life insurance played a big part in our family back in the day. But I'm the founder of Momentum Strategies. We're a holistic financial advising firm based here in Dallas. One of the things that we talk about strongly with our clients is a protection-powered strategy. And a lot of the protection that we talk about involves life insurance. And so I want to dive in. Have to give some disclosures. This is just an educational session, so anything that we say is just for information. Just have to get the lawyers out of the way. But this is what we're going to talk about. What is life insurance? How much do you need? How much does it cost? What might be some of the reasons you'd purchase life insurance? Then we'll hear from a couple of audience members to talk about their personal story, just to bring it to home, because a lot of people think, well, that's not going to apply to me, or I'll really never need it. And the honest answer is we don't know. And so life insurance is really there as a tool to help you plan for the unexpected so that your family can continue the legacy and the goals and dreams that you had in place. And then we'll do, I put on our final examination. It's really, we're going to play some bingo to make sure you heard the main concepts that we talked about. I want to make sure you leave here with some content so you feel more comfortable with life insurance, how to explore it, what types might be the best for you, how much might be the right amount for you. So I want to make sure you leave this seminar comfortable and confident so that you can take action and not just absorb the information, but really take action. And that's what Momentum is all about, is helping to put little steps forward to help you, make some progress towards your goals. So with that, life insurance. So let me hear from you guys. If you had to put in your own words, what is life insurance? Let me hear an example or two. What is life insurance?
I would say income protection.
Income protection?
Yes.
Yes, no, that's a great one. Anything else?
At a minimum, burial insurance, but hopefully more than that, a substantial amount to leave your family to help with legacy, or we say generational wealth.
Generational wealth, legacy, income protection. Any others come to mind?
Yes, so grief protection.
Grief protection.
I guess that's a way to say it, yeah.
Yes. No, that's one that a lot of people underestimate, is the amount of time you need to grieve and what life insurance can help you in that sense.
I want to
Yeah.
I would just say could be a last love letter.
Last love letter. Oh my gosh, we got some great ones in here.
Okay, that beat me. So the way I look at it too is life insurance is that safety net, because we all know that we've done things that we probably should not have done. Our actions have not been in alignment with our values when it comes to saving money for retirement or saving for things that are important to us, right? But life insurance is that safety net. It's that, like when you go to Vegas and you get insurance for blackjack, it's the thing that says, hey, if I don't practice sound money management behaviors for myself so that I have wealth, I can then have life insurance to give my family a leg up. So what do you want to call that? That's like life. That's like blackjack insurance or something, right?
Right, right. So instead of blackjack, you're helping to protect your own life. And so let me ask, which one of these items do you think doesn't apply to life insurance? You know, we've heard some similar comments today. So does I love you correlate with life insurance? An obligation to take care of those you love in case you can't? Contract between an insurance company and an individual? Any of these don't apply, you think?
I didn't understand the question.
So do any of these not apply to life insurance? So a legacy for future generations. So it's a trick question. All of these really,
I would say all of
yeah, all of these really are great reasons to have life insurance and purposes and explanations of what life insurance is. And really the first one, I love you, is it catches some people off guard, but it really is, you know, a love letter to those that you care the most about, because you aren't going to benefit from your death. Your loved ones will have a check given to them in the untimely event of your passing. And so it really is saying to them, hey, I love you enough to give you something in case I'm not here to be able to provide. And so this really is a trick question where they're all great examples of what life insurance is. And so what are some, we already heard what are some of the reasons why you might need it, you know, in terms of income protection, in terms of protection to help you grieve, give you time to grieve. I think of it as it's a catastrophic protection. So it's really something that you don't want to happen, but in case catastrophe hits you or your family, it's there just in case. And so it's not something that you want, but you're really preparing for the future and what you might not be able to predict. We heard about legacy. And so when you talked about generational wealth, explain a little bit more about what you mean by legacy and generational wealth.
Leaving money for the next generation. And in the African American community, a lot of times we leave debt. And that's why I said burial insurance first, because now in the Black community, so many people are unprepared, and we have so many young deaths that GoFundMe has become the life insurance of our community, unfortunately. So at a minimum, burial insurance, you know, for our in our community to cover burial costs, but then beyond that, having money for the next generation to start a business, to pay off a home, and then also with the life insurance, being able to borrow against it is something we didn't, you know, we don't know enough in the Black community. But I would like to say that my father, who is 84, has become disgruntled with so many people that he does not have life insurance, and he says that he wants us to pay for his. So I mean, he's loaned so much money to people over the years, and they haven't paid him back. So it's an interesting story that he's like, I'm not. You know,
He doesn't
y'all are
wanna
gonna
leave,
pay.
yeah.
Yeah, he's like, I gave enough to you while I was alive, and so I don't care what happens when I pass. So I have an interesting story with
So
him.
that's the opposite side. But right. But you'd mentioned so many young people have passed. I mean, give me an example of the age of some of the people you know have passed away. I mean, a lot of people think of life insurance for older people,
Well, I mean, we have so many teenagers, 15, 16, 18. I live in Oak Cliff, southern Dallas, and unfortunately, we have a death every weekend, seems like, of someone being shot. So we have so many GoFundMe's. But then we also have women, girls 25 with breast cancer. They may have died unexpectedly, or, I mean, it's all ages from 14 up. You know, we've had, and then, I mean, like the tragic accident on 20, and was that in Terrell, Texas, where the truck driver went into the family of 5 were killed. The one teenage girl was saved. She lost her leg, but she was the one saved out of 5 people. And they have a big GoFundMe for that tragedy. So
Yeah, so a lot of people think that life insurance is just for adults, when in fact, many insurance companies will insure a baby the day after they're born. As long as there's no complications and they were born healthy, you can often insure a baby right the day after they're born. And then to the other end of the spectrum, there are insurance companies who will insure people who are up to 85 years old. And so if you're looking for burial insurance, final expense insurance, you can go all the way up to 85. And you said your dad's 84? So, it's not too late to convince them.
It's not too late. So you asked what generational wealth is. Dr. George Fraser said in one of my shorts that generational wealth, the way it can be defined, if you don't have a business to pass on to your future generations, could be, do you have enough money to actually pay for your children's education without sticking them with a student loan? Or even if one of your children are getting married, do you have enough money to not only pay for the wedding, but how about just buy a house or even a down payment for the house?
Yeah,
and so
those are perfect.
And if you don't have those right now, but if you pass away early or prematurely or before you were able to create that wealth, then life insurance can be used for those type of generational wealth transfers.
Absolutely. Now, business continuation, number 4. A lot of people who either don't own their own business or never have thought of it as from an entrepreneur, that might be something new for you, but just imagine that you were in business with your best friend and you pass away and you were the main person who ran that business. Now your best friend, who might have been just the accounting person for the business, not the salesperson, not the operations person, they're now potentially in business with the deceased partner's spouse, and maybe the spouse doesn't want to be in business with the best friend, or maybe they don't know anything about the business. Oftentimes, business owners will get policies on themselves and their partners for business succession so that the succeeding owner has the ability to go hire someone to replace you so that the company can continue, because you've put forth blood, sweat, and tears into this business, and you have 10, 15, however many employees. You want to make sure their jobs can continue. You want to make sure your business can continue. And then you can also have money to pay to the loved one's family because your income's not there anymore. So it's often used in businesses as well. And believe it or not, 61% of those who have life insurance, who don't have it, say they need it. And so it's one of those that people often put off. And so that's why September for Life Insurance Awareness Month was created, was to bring more awareness to it, to hopefully motivate people to take action and move forward. So any questions on this?
Would you also say that it's a form of risk management?
Risk management, yeah. So is it a form of risk management? Absolutely. There's lots of risks that we face in our life. We get car insurance in case we get into an auto accident. We have home insurance in case something happens to our home. This is protecting your life. Believe it or not, in the state of Washington, they mandate that you have to get long-term care insurance because the statistics are getting so high that people are needing it later in life. That's now a requirement. Every working individual in the state of Washington has to have some sort of long-term care insurance. And so it's a form of risk protection and risk mitigation, absolutely. So there's two basic types of life insurance. You have what's called temporary life insurance and you have permanent. So when I say temporary, is there a name that comes to mind? It happens to be on the term. So why term? So term means you're going to have a policy for a certain term, for a certain number of years. And so think of it as I'm providing this to cover a certain situation, a certain chapter in my life. So maybe you have a house with a 20-year mortgage and you want to protect that mortgage in the event that you don't wake up one day and you want to be able to pay that house off so your family doesn't have to worry about it. So that's what would be an example of a term or temporary policy that's going to cover you for a certain number of years. We also like to think of that as you're renting that policy. Just like you're renting an apartment, at some point you're going to have to move out or the rates might change, and so you're not locking in the cost of it forever, it's only for a term. And so catastrophic, temporary, rent and term are often phrases you use when you think of term insurance. Term insurances can go typically from yearly up to 30 years, sometimes even 40 years. So they can last a long time. And so people will often get those when they're in their 20s, 30s to last them while they're working, last them until their kids get out of high school, out of college. Lots of different terms that people identify their temporary coverage for. But that's one category. And then the other is permanent. So permanent would be comparable to like buying a house. It's something that you're going to intend to keep your whole life, which is the name of a very common permanent policy is a whole life policy. Think of you're buying a house. You're building equity in your house as opposed to as you're renting, you're not. Another difference between term and permanent. You're buying it. You're actually planning to own it so that after it's paid up, it can't go away. And so who's heard of the differences between term and permanent before? Is this concept you guys have heard? No?
Well, I never understood it. That's why I'm here.
Okay. So other names of permanent policies, you have universal life and whole life. Slight differences. Some are more focused on building cash inside the policy, and others are more focused on providing you the largest death benefit possible inside of your policy. So if you're really focused more on building cash so that you can use it as a living benefit while you're alive, we'd probably direct you to whole life because it's building up dividends and cash value inside of your policy, much like equity is being built up inside of your house. If you're more focused on, I want to have the largest death benefit possible when I pass away, and you don't care as much about cash while you're alive, universal life might be where we direct you because it's more focused on the largest death benefit and not as much on the cash value. So those are two types you've probably heard out in the marketplace, but one is permanent and one is temporary. Now, in this rental market for apartments, it might not be the same where it's cheaper to rent versus buy, but in life insurance terms, it's typically cheaper to rent a policy versus buying a policy. Now, why do you guys think there's such a drastic difference in cost?
Because most of the time, the life insurance company is thinking you're not going to use it term.
Right, so what percent, yeah,
I want to make sure that the audience can hear.
Yeah.
And then
Yes.
pass that talking stick around.
Sure. So I was just saying that it's because I think the life insurance company doesn't think the likelihood of you using a term policy is as good as it would be for a whole life.
Right, so what percentage of term policies actually go to claim? So what percentage of people who have a term policy actually die while they have it? What guesses would you guys say?
Talking stick.
Talking stick.
Why don't you guess since you have to?
25%.
25%? We have any other guesses?
I would say 10%.
40%?
40%. 10%? Any others? Believe it or not, it's less than 2%. Less than 2%. And so that might beg the question, well, why should I get it? Because, 2% versus 98, if you just happen to be a part of that 2%, it makes all the difference in the world. And the cost is such that you can justify the cost because it is so much cheaper than permanent insurance. And so that, insurance companies price it that way intentionally so that they can help you with that temporary coverage and also cover their risk. So hopefully that helps to explain the difference between temporary term and permanent, which might be whole life or universal life.
I have a comment online. So one commenter online, Annette, says that her mother will be 88 in 6 months, and they found a place that will insure her until she's 89
Okay.
at $232 a month. And she says, so if she lives past 89, the money will be gone, and I will be starting over with money, I guess. But that's interesting, like up to 86. But there's some conditions in that, right? Because there's a high likelihood that the insurance company will pay out, so you're going to pay for that.
Yes, you need to read the fine print because there are policies called graded policies where for the first year or two, if you pass away in that time frame, the insurance company will return the premiums that you paid plus a small percent, like maybe plus 10%, but they're not going to pay the death benefit. And then after 2 years, then they would pay the death benefit. And so usually if you see some for older people, they might have some graded terminology attached to it. So you do have to read the fine print, but that's what your agent is there for, to help you understand that. So how much do I need? This is an interesting conversation that we have with individuals who've never really sat with an insurance professional. And we look at it with three different ways. You look at what you have kind of in your rear mirror. What is obligations that you already have? Then you're looking forward. What's the income that my family is going to miss out on? And then it's maybe some other specific needs that you might have. So when I say looking backwards, what obligations do you have that you would want covered in case you weren't here tomorrow? So you might have a mortgage, you might have school debt, you might have personal debt. Those you wouldn't want to leave and burdened with your loved ones, and so you might add those numbers up. So if you have a $250,000 mortgage, you have $100,000 in school debt, and you have $50,000 in personal debt, you might add that up to get to $400,000 that you love to stroke a check and not burden your family with. And then if you look forward, you're thinking, okay, what income is my family depending upon for all the goals that we have? Sending our kids to college, funding our retirement, paying for our kids' weddings, things like that. And so that's going to be paid for with your income. And so quite often you'll look at, well, let me take 10 years, 15 years. Let me take until my working years. So if I'm 30 and I plan to work till 65, you might say, hey, I need 35 years of income. And so just some quick math, if you're making $100,000 and you need 30 years of income replacement, how much is that right there? 30 years times 100,000 is 3 million. 3 million, right? So that's how people get to $1 million policies, is you're typically adding up the loss of income, so your human economic value. So this is the economic value that you're contributing to your family. And it can be anywhere from 10, 15, 20, 25 years of income that you want to replace. And then if you have a $250,000 mortgage, some student loans, some personal debt, you add that to it, and that's how you can get to an amount equal to what you might want to get for your policy. Now, you don't have to put that all into one policy. You can have multiple policies. A lot of people don't realize you can have as many policies as the insurance company will underwrite you for. And so you might have a policy that just covers your home. So maybe you have a $250,000 policy for 20 years. And then you might have a permanent policy for $100,000 to take care of your final expense and leave a legacy for your kids. And then you might have another policy that's for 10 years because you know you plan on paying for your kid's wedding in the next 10 years. And so you can have multiple policies to fit the different situations that you're faced with and add all of those up to get to your total insurable coverage. Does that make sense? Yes?
Yes.
So questions on that? Any questions?
Well, there are some questions, but I want to save them to the end.
Got it. Okay. So how much does it cost? So if and I did a quick run. So for a 45-year-old person, male, who wanted $1 million policy for 20 years, just think in your head how much you think that's going to cost. And so when you look at cost, let me break that down for you too. The three main factors that contribute to the cost are your health, your age, and risk factors that you're involved with. And so health could be, do you have a medical condition that accelerates your likelihood of dying? So what's your mortality impact to your health condition? So do you have high blood pressure, diabetes, a heart condition, you name it. There's whatever health condition you have, underwriters have calculated how much risk does that add to your life. And so underwriters will look at what's your health. And then your age. Why your age? Because the older we get, the closer we're typically getting to when you're going to pass away. So the older we are, the more expensive a policy is. And then if you're a very risky person, you like jumping out of hot air balloons on the weekends, you like scuba diving 500 meters below surface level, you drive a race car, those are risky conditions that are going to add to potentially the cost of your policy. And so underwriters will look at, those three buckets to come up with your rating. And so you might get a select preferred rating, which is you're very healthy, not much risk, to a smoker rating and you're class 12 because you're very risky, and anything in between. So for a 45-year-old male who's wanting $1 million of coverage, who's very healthy, what would you guys guess would be a monthly cost for an average insurance company for a 45-year-old who wants $1 million of coverage? How much do you think that would cost a month? Throw out some numbers.
Probably
$100?
$125.
$125? $45? And you guys guess? $200. All right. So believe it or not, I just ran this before the meeting. It costs about $45 with an average insurance carrier.
Say his age again.
45 years old, male,
45.
who is very healthy,
Okay.
and they want that coverage to last for 10 years, would be about $45.
And the race doesn't matter?
Race does not matter. Race does not matter.
Zip code?
Zip code does not matter. We don't look at your zip code. It's all about health, age, and risk factors. They're not looking at your zip code like the property and casualty companies are.
Weight would go into the risk factor.
Weight would go into your health, because if you're overweight, that contributes to your mortality. And so a female, same conditions, $1 million, 10-year, 45 years old, would be $37 a month. Why is it cheaper?
Because women are said to outlive men.
You said women are the superior sex? Oh,
We are, I didn't say that.
you didn't say that. Okay. Women tend to live longer than men, and so the risk to the insurance company is less because they know they have a longer time. So it's a little cheaper. So do those numbers surprise you?
Yes,
They do because
and I've been quoted much higher. That's why I don't have any. Yes.
for $1 million, so healthy, right weight,
Right.
all of that is played into what.
It is. So you have to be healthy. That was a healthy 45-year-old
Non-smoker.
non-smoker. And so I didn't talk about smoking. So smoking is another. So typically if you smoke versus non-smoke, you're talking about double the cost if you smoke versus you don't smoke. Again, because of the factors contributing to your likelihood of dying. And so now, any questions on that? So now I want to bring up two of our audience members. So we have here with us Miss Kathy Phillips, and she's been so gracious to share with us her story on how life insurance affected her family. So come on up so the screen can see you. So let me just ask, so give us the backdrop on how life insurance, what it meant to your family, and the story that kind of brought you here today.
Yes, so it meant the world to us. I was 36 years old. My husband was 40. We had a 5-year-old and an 8-year-old at home. And he had a motorcycle accident and didn't make it. And it was devastating. And luckily, I had been in the industry at a bank to know that I did need life insurance. And it helped a lot, but we were a young family struggling. I didn't really have enough, but I had enough to make a big difference, the world difference for me and us.
Now talk a little bit about the timing of, your job, your husband's passing, the types of policies that you had.
Right, so it was very crazy. I worked at a bank and knew about life insurance. Of course, I had life insurance through my employer. It was limited amount, but my husband did not have insurance through his employer. And he was a little overweight, and we were buying a house, young kids to raise. So I thought it would be really good to go out and get individual insurance. So I called my auto insurance carrier because that was the only one I knew at the time, and told him I would like to get life insurance and for me and my husband. And so we went through the process and got it, and just 2 years later is when he had his accident. And the reason also that I wanted to do that is because working at a bank, to move up, a lot of times you have to change companies. And so I had done that a couple of times, so I wanted to make sure if that had ever happened that I would have it anyway. And that's exactly what happened. So I was working at one bank, and my last day was on Friday, and my coverage stopped on my last day, right? I was due to start my new job on Monday, and he had his accident on Sunday. And had I not had the individual policy, I would have had nothing. And so it still just gives me cold chills thinking about it. It was enough to pay off our house. It was enough to help me stay home with the kids at 5 and 8, they were, of course, devastated. Their dad was their whole world. And I had been with him for 20 years. And so I was 16 when we met. He was my whole world. And when the next day never came, luckily I had that life insurance that allowed me to stay at home. I never started that job. I stayed at home for a couple years and took care of the kids, took care of myself, got us back on our feet. And also I was lucky enough to have enough that when it paid off our house, I didn't have to uproot my kids at the worst time in their lives. They were able to stay around friends, stay in the same school area where they ended up graduating from the little timeline from elementary, middle school to high school. And I truly believe that impacted their life, having that stability when I wasn't able to give them the other stability of a father. So I would have had to move in with my parents out in the country, and that would have been a huge change.
And so I'm sure you guys have heard similar stories, but I want to thank Kathy for being strong enough to come up and share hers, because you just don't know. You really don't know. And all of the factors that we talk about to clients of, you don't know when that day is. You don't know when you might be uninsurable and unhealthy. You don't know if you're going to have that job. And so make sure you have enough to cover those important items in your life. So thank you. So now we're going to switch to the, and then Clifton. Sorry about that, Clifton.
Yeah, this will be real quick, Mark. So again, so my life insurance story, I want to share with you three things. Number one is my first experience of life insurance was when I was in my 20s. My mother and father passed away in 1983. My mom at 46 years old, and my father passed away in 1988, around 5 years afterwards, exactly to the T, to the month almost. I'm not sure if my mother had life insurance. I knew that my father made a lot of sacrifices. He worked 2 jobs for 12 years to put us through private school. And when my mother passed, my father and her family really took care of a lot of the arrangements. But when my father passed 5 years after that, I was the one I was married, had a child, I went to college, I was the most financially stable of my siblings, and I was involved in the decision making. So I found out that my father had a life insurance policy, but at that time he had put the beneficiary as my oldest brother. And my older brother at that time was actually hooked on crack. And right after my father's services, he disappeared with his strawberry and was gone from 1988 to 1994. And I had to find him in Los Angeles. I was going around neighborhoods just looking for him because he was spending that insurance money. So my experience was that I was able to find him and get the money out of the bank before he spent all of it, but was very little left. And so what we did is we had to unfortunately sell the home that he had bought in Los Angeles, and split amongst us and put money into conservatorship for him, the remaining, the proceeds from the sale of the house. But the life insurance money was gone basically. And so the intention of my father though was to really help set us up. And his intention was to provide the beneficiary as the oldest son, thinking that he was going to be responsible, but he knew that he wasn't. But he didn't go back and change the beneficiary at that time. So that was my first experience of life insurance. When I was married though, and having experienced that, you would think that I would go back and make sure I have life insurance for my family. But I didn't initially. I was just so caught up. And I was listening to my insurance agent. I was looking at papers. They were trying to convince me getting permanent insurance versus term insurance. But before I got into the industry as a financial advisor in 2004, I really didn't pay a lot of attention. I didn't start paying attention until I was in the industry as a financial advisor in 2004. And at that point, I was going through underwriting, I believe in 2008, 2009, and I found out that I had a heart condition. And I was just telling Mark that I was relatively healthy beforehand, but when I had that heart condition, I was then rated, and you can explain to them what that is. Well, basically, my premium is 3 to 4 times greater than what the average healthy premium is. And it was just a shock to me. It was a shock because of the commitment that I had to make in making the premium payments, but also it was the reality that my beneficiaries will be more than likely to get a check from the insurance company than someone who is healthier. So that was my first experience of really making the commitment of, is it important for me to provide for my children or to me to live off the money I have now when it comes to premium payments? And the last story I'll tell you is about your health changing. There was a question online about what affects your premium payments, your age, but also your health, and how early should you get life insurance, and you can get it as soon as the baby's born. I would say getting life insurance, the younger you can get life insurance and the healthier you can get life insurance, which is the sooner, is best.
The better, yeah.
I have now prostate cancer. So in 2023, I was diagnosed with prostate cancer. So that, I have to have, 5 years before I can probably get another policy. So the policies I have now are intact, and I'm glad I have them. But the likelihood of me being able to get more right now, since I have stage 3 prostate cancer, is not high, not likely. So definitely what I've learned from this is you should take a look at your insurance needs every year, just like you go to the doctor every year for checkups. So whether you feel like you need insurance or not, I think it makes a lot of sense to sit down with a professional and talk about insurance, the different types of insurance, how much it costs, whether you need insurance. Just do that every year, whether you feel like it or not, because you never know when a health condition is going to pop up, and it's guaranteed that you're going to get older every year. So you should do that probably 2 months before your birth date. I told you September is my favorite month. September 30th is my birthday. That's usually the
Happy early birthday.
Right. That's usually, like in August is the time I take a look at where am I? Did I accomplish all that I wanted to accomplish? And I think that's a great opportunity for you to take a look at your life insurance, talk to a life insurance agent or financial advisor, and just reassess, do you have the right amount, the right type? And you can always learn something. So that's my story.
No, I appreciate you sharing, Clifton. Clifton brings up one other point, is the need to keep up with your policies, because life happens, life changes, and updating your beneficiary is probably the biggest oversight that we see with clients. You get divorced, but yet your ex-spouse is still the beneficiary. If you haven't changed it, that money's going to them. If your parents are your beneficiaries and they've passed away, now you have to figure out where it's going. And so it's really helpful to review those policies at least once a year, just to make sure everything's up to date. Not necessarily get more, but just make sure it's up to date. So now we want to shift to the quiz part of the afternoon with bingo. So on your page you have a quick bingo card, and we're going to ask questions to make sure you were listening, and there will be prizes for people who can shout out answers to the questions that I have. So it's going to be rapid fire. I'm going to...
So no need for the mic, right?
Yeah, you're going to be shouting out answers. And so listen carefully. I'm going to be asking questions where the answers are on the page. I want you to shout out the answer in case someone might not know the answer, so that they can mark off on their page.
And let the online audience know that if they want to look at their cards, just to follow you, the links are beneath or is in the live chat.
So for those online, there is a link for you to download a card if you want to follow along, and type in the chat if you win, or even type in what the answers are so that we might be able to send you a gift remotely.
And I just put the link in the live chat as well for the bingo card.
So we made it easy. So it's 4 in a row as opposed to 5 in a row. So if you happen to have a square that says free, that's a free square. So you can mark that one off automatically. So let's get started. You guys ready? Okay. So what type of life insurance is like renting? Term. All right. If you got that, mark it off. What do we call the impact you leave behind for loved ones or charity with life insurance? Legacy. Got it. If you got that one, mark it off. What is the name of the educational series you are attending right now? What is that?
Empower Series.
Empower Series. If you see that one, mark it off. What 3 little words describe the emotional reason people buy life insurance? That's one. Okay, that's one. So say it again. Peace of mind. What's another one?
I love you.
I love you. So peace of mind and I love you are three little words that people have as a reason for buying life insurance. So what is the number one factor that makes life insurance more expensive as time goes by?
Age.
Age. You guys got that? Age. What lifestyle choice can double or even triple your life insurance costs compared to a non-smoker? Smoker. When you choose permanent insurance, are you essentially renting or buying protection for life?
Bye.
Buying. So do we have any that have 3 in a row yet? 3. Okay, so we're getting close. All right. What stage of life can permanent policies help supplement through cash value access? So what stage of life? Retirement. What future expense can parents secure for their children using life insurance benefits? College funding. What is the financial term that measures the lifetime earning potential you bring to your family?
Human economic.
Say it again.
Human economic value.
Human economic value. Do we have any bingos online, Clifton?
I'm checking that.
Not yet? Any here? We're still waiting? Okay. So, what big family debt can life insurance ensure your loved ones won't lose their home over?
Mortgage protection.
Mortgage protection.
Bingo.
Bingo. We got a bingo? Yes. All right. So we'll keep going. But what are the 4 that got you bingo?
Age, buy, human economic value, and mortgage protection.
There you go. All right, let's keep going. So what type of permanent insurance provides guaranteed cash value growth and lifelong coverage?
Universal life.
Nope.
Whole life.
Whole life. Cash value was the key word there. Close though, very close. So what type of permanent policy offers flexible premiums and death benefits tied to interest or investments? Universal life. What is the housing analogy used to describe term insurance? It's like renting. Bingo, another bingo. Any other bingos? We got another bingo? You got a bingo? There you go. We got to get everybody here bingo. All right. What is the key factor insurance companies evaluate before approving your policy? What was it? Risk. Yes, risk. What type of life insurance lasts for your entire life and builds cash value? Whole life. What's another? Permanent. So what word describes someone who waits too long and can no longer qualify for coverage due to health issues? Uninsurable. And uneducated. That's not good. No, I didn't say
I
that.
take offense to that.
Okay. What is the name of Mark Howard's company?
Momentum Wealth Solutions.
Yes, Momentum Wealth Strategies.
Bingo.
Another bingo. So wait, has everybody got one? You haven't got one, Kathy? Oh my gosh. Richard, you got one? So what awareness month is celebrated every September to remind
National Life Insurance Award.
Life Insurance Awareness Month? And what legal document defines the agreement between you and the insurance company? Contract. What personal factor, along with age, has the biggest impact on your insurance premiums? Health. There you go. So if we got everybody, I think we got everyone. So hopefully that helps to reinforce some of the concepts that we talked about.
So, you know, we're almost at the end, but I want to make sure that we answer any questions.
Yes.
So we're going to run a little bit over to make sure that the online audience and people here are able to ask you questions that they have not been able to get answers to yet. So I'm asking that online, and go ahead and kind of open that up for Q&A.
Okay, yep. So are there questions yet? So what questions do you guys have?
How hard is it
Oh, hold on.
How hard is it to get approved or go through the process of applying for insurance?
Yeah, so the steps to get a policy are you have to fill out an application. The application typically is, you know, your date of birth, your social security number so that they can validate who you are, your driver's license because they want to check your driving record to see how risky you might be from a driving perspective. They're going to check the prescription database to see if there are some prescriptions that cause question about your health. They'll typically ask your primary care physician for a copy of your medical records. If they need it, and a lot of companies don't require it anymore, but they might, they'll ask you to do an exam where they'll send someone out to you to get a little bit of blood, a little urine, check your blood pressure, your height, weight, things like that. Then they look at all of that and they'll come up with an answer of, are you approved or not? And if you are approved, what rating do you get? That can happen as quickly as a day to a couple of months, depending upon how hard it is for them to get access to your medical records typically. But it's really straightforward. There's typically no cost to apply. So I always encourage people to apply to see if you get approved, and then if you do, at what rate, so that you can then decide how much coverage fits within your budget. It's a great question.
Okay, I have two great questions here from Jonathan Ortez. The first one is, if my financial situation changes, can I adjust my coverage without starting a new policy?
Yep, it's a great question. So if your financial situation gets worse to where you can't afford the amount of coverage you have, you can often go to the insurance company and say, hey, can I lower my face amount? Can I lessen the death benefit that I have on my policy to fit within my budget? And when you're lowering the size of your policy, you don't have to go through underwriting again because the risk to the company is not getting greater. They've already underwritten you for that $500,000 policy for $47, but maybe now you need it to be $25 and maybe it's $250,000. So you can just fill out a form and they can reduce it. If you wanted to increase it, that's when you'd have to go through underwriting again so that they can see if you are fit for that increase.
Okay, they're coming in large.
Okay.
I want to hit these up because you guys are in the audience. We can deal with that after we go offline. So the other one is, how will inflation affect the real value of my death benefit over time? That's a great question.
Yeah, so inflation is going to affect the purchasing power of your death benefit just like everything else in life. So if you purchased the policy at age 20 for $250,000 and you don't die until 95, you know, it's going to erode worth at, you know, 2.5% a year, so that the amount it's going to pay for is going to be significantly less. And so you do have to take that into factor when you're looking at a policy, but also as you evolve through life, that might be why you'd get another policy later at 35, at 45, 50. But inflation is definitely going to affect the purchasing power.
Then what will my beneficiaries owe in taxes on the death benefit under any circumstances? I think there's, for the death benefit, there's nothing, but the cash value there might be. So go ahead and explain that.
Right, so one of the oldest items in the tax code is that death benefits are still tax-free. That's not guaranteed because Congress could change that provision, but It's one of the longest standing tax codes, is that death benefits from insurance are tax-free. Now, if your policy happens to have cash value, it could be that some of the cash value is taxed. It just depends on, has the cash value exceeded the amount of premium that you've put into it, and then they'll analyze if you owe any taxes on that amount. But for the death benefit, currently it's 100% tax-free.
And so I'm getting some good questions from the online audience. So, and I think those are great questions because a lot of times, that's why it's important to review every year these policies that have cash value because they're complicated. And then also, because of the inflation, you might get a $1 million policy now, but then 30 years from now, that $1 million policy is not as valuable as it is
Just
today.
real quick, I have lots of older clients. I have policies that come up that are $5,000 in face amount, $10,000 in face amount, because they took them out 40 and 50 years ago. And so it's a great point of, that might have seemed a lot back then, but now it's not as much because of inflation.
So the other question is, what if your health improves? Can you reapply? So talk about that.
Yep, so most insurance companies, I don't want to speak for all, but most insurance companies will allow you to apply for a rate reduction. So let's say you were smoking and then you stopped smoking. You can go back to the insurance company, typically every year, and say, hey, I want to apply for a rate reduction because my health has improved. And so you submit an application just like you did at the beginning. They'll evaluate it and they'll give you your new rating. What's nice about that approach is, and that process is, let's say you misread your health and it came back worse. You can reject that rating if it came back worse and just say, hey, I want to keep what I have. But if it came back better, they can apply the new rate, lower your cost, and have you keep the same coverage at a better rate.
So again, that's a great reason to get insurance earlier while you're young. What happens to my policy if the insurer merges, gets bought out, or goes bankrupt?
Okay, so if you have a policy and two companies merge or get bought out, typically the acquiring company assumes all of the outstanding obligations from the company that they acquired. And so your policy will still be intact. It just might be written by a different insurance company. That's a reason why you want to understand the financial stability of the company that you're working with, because they're essentially giving you a promise that they're going to pay when you have a claim. And so the less financially healthy a company is, the harder they might make it for them to pay out that claim. And so if they go bankrupt, there is insurance protection offered by the government up to a certain amount. So you do need to check that with your insurance company and your agent on what the specifics are. But great question, and a really great reason why you want to understand the health of the insurance company you're working with. And it might be why they're offering such a cheap rate, is because they're unhealthy and they're trying to get as many policies as possible.
Okay, and the last two questions here, and I think these are good because they lead into estate planning issues, but the first of the last two questions from online are, what protections exist if one of my beneficiaries has debt collectors after them, right? And then the second one is, can I set conditions for my beneficiaries like staggered payout or age restrictions? So I think that leads to the use of estate planning and trust, as well as, and address this as well, when someone passes away and they have life insurance and they're giving that money to their beneficiary, those beneficiaries do not have an obligation to pay off the deceased's debts.
Correct.
So explain, answer that question thoroughly.
So if one of the beneficiaries, so was the question if the deceased had?
That wasn't the question, but it's twofold.
Yeah.
If let's say if I pass away and I'm giving money to my daughter, and that daughter has debt collectors after her, that was the question.
Right.
But I added to that the fact that the money going to the beneficiaries, those beneficiaries are not obligated to pay off my credit card debt if I die, and that's part of their estate, they're going against my estate.
Right.
They can choose to, but they don't have to.
Right. So if the beneficiary is in debt and has debt collectors coming after them, they're receiving the check directly from the insurance company. So if they deposit it, spend it before the debt collectors get to them, that's up to them. They can choose to use some of that to pay off the debt, but it's an individual situation where, it's not going to the debt collectors first, it's going directly to the beneficiary. If the deceased has debt, again, the insurance company is paying the beneficiaries directly. They're not going to ask, is there debt associated with this client? It's going to go straight to the beneficiaries. And the beneficiaries, if they want to help pay off the debt, they can. Ultimately, that debt is going to go into the deceased estate, and then whoever is the trustee for that estate is going to have to deal with the debt. But it doesn't have to be satisfied with the life insurance policy, but quite often people use life insurance policies to clear up taxes and debt that are within the deceased estate. And so it's a great tool to use for estate planning, but it doesn't have to, you're not forced to use it for that. It goes straight to the beneficiary, which is why you want to update your beneficiaries every year to make sure it's going to who you want it to.
And again, we'll have more. Next month's workshop is going to be on estate planning, but there are different types of trusts that you can create, like a spendthrift trust or special needs trust that provide some level of protection, or you can control beyond the grave how your money is dispersed to your beneficiaries, because that's the last question. Can I set conditions for my beneficiaries like staggered payouts or age restrictions, which are usually done within a trust as opposed to a life insurance beneficiary claim?
Yeah, so most life insurance companies, if you're designating a minor as a beneficiary, will help you to set up a uniform trust for minors where you have to designate a guardian who's of age, who's an adult, to look after the trust and your minor, but it won't get paid out to them until they're typically 25. And so that's one that the insurance companies can set up for you at no cost. It's built into the policy, and you set it up as one of the beneficiaries. But if you have your own trust, you can be more specific and more creative to stagger it out. But within the policy, you can create a UTMA, as what it is, Uniform Trust to Minors Act, and you just have to designate a guardian to look over that minor until they become of age. And then at that point, the minor will become the direct beneficiary of your policy.
Any other questions in the room?
So what's the difference between the UTMA and the UGMA?
They're, I forget what the G stands for. Uniform gift? Yeah, so most states are using the UTMA. I think it's state dependent as to which one is more prevalent, but they both are serving the same purpose of helping to have the minor beneficiary be covered so that they're not getting $1 million when they're 5 years old.
Oh, okay.
Or under the age of 18.
Or under the, while they're a minor.
Thank you.
But great question.
You talked about term insurance being less expensive than whole life. What is usually the difference in price, or how much more is whole life? Now, did you say there are 3 categories: whole life, universal life, and term insurance? So I assume, and then universal is more expensive than whole life?
Universal is typically less expensive than whole life.
Oh, okay.
Yeah.
So what would be the differences generally in a whole life policy?
So don't hold me to this because it varies by condition, insurance company, age, health, but roughly a universal life policy is going to be 5 to 6 times more expensive than a term policy. And a whole life is typically going to be 9 to 10 times more expensive than a term policy. But remember, in a universal life policy, you're locking in that death benefit typically for your whole life, whereas in a term policy, you're just renting it for a certain period of time. So if you rent it for 10 years, then in the next 10 years, your cost has gone up. And then the next 10 years, your cost has gone up, 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 and up. And so over time, it's typically more expensive to have consecutive term policies than it would have been to have had a universal or whole life to begin with. But because it's 5x and 10x the cost, a lot of times your cash flow can't afford it. And so that's why we encourage you to layer policies to have, maybe you have a smaller permanent one, and then as your income increases, you convert those temporary policies into permanent and you buy them. But, and also in the whole life, you're receiving cash back from the insurance company. So quite often the cash that you're putting into the policy, you're getting back. So it's really just a matter of your cash flow of can you afford to have the cash go in and then come back to you at 10 times the cost versus it'd be cheaper, but you're not getting anything back if you don't die. So 5x to 10x is kind of a rough guesstimate. There are some that are cheaper, some that are more expensive, but that's kind of a guesstimate as to it. But you're not building any equity in term, you're renting it. And so unfortunately, like as in Kathy's example, her husband passed while they had that term policy. But remember, only about 2% have to file a claim. And so for those other 98, if they would have gotten a permanent policy, it probably would have been a better return on that investment of premium.
Okay, my main question is about the prevalent calls and commercials recently about life insurance, and I don't know if you're aware of that. I don't know if this is just because they say the government changed something, but I've been getting inundated with calls about life insurance, something that I guess Texas changed, and also commercials. They're saying it's a benefit from the government or something. So I don't know if that's just a scam or was there something recently that came about with the life insurance?
I'm not aware of any laws or benefits that change. So my guess is they're using creative language to try and get a conversation with you to talk about their policy is my guess. Because the Secure Act didn't really affect the ability to get life insurance.
Because
big,
it's
beautiful
been
bill.
in the last 3 months.
Really?
I get a call every day about, and it starts out saying the government has changed something. You can get life insurance cheaper, something with the government, and then it's on television and commercials too. But
Yeah.
maybe I'm just in that algorithm. I don't know, but
I think
I
you
thought
might
there was
be.
something different.
I'm not aware of it. I'm not to say that there isn't something out there, but I'm not aware of a government program. I would look at the fine print to see if it's just creative advertising to get you to the door. And unfortunately, you might be a part of some algorithm because you typed in life insurance and that cookie was sent to different companies. But no, I'm not aware of any government enhancement. Yeah. Any others? We got time for one more?
I wanted to know more about your company in general. Like the history of your company, is it associated with a larger insurance company or is it in a standalone insurance company? You didn't really talk a lot about your specific company.
Yeah, no, great final. So again, Mark Howard, founder of Momentum Wealth Strategies. I am also a licensed agent with New York Life. That's the parent company for our firm. We are standalone so that we are able to offer other insurance companies as well. So we do broker and work with about 20 of the top major insurance companies as well. We do provide holistic planning. So we are a financial advising firm as well. So we help you with retirement, life insurance, investments, estate planning, and everything in between, and are happy to help with anything that you need. One of the new offerings that we have is what we call a second opinion service. So even if you have a life policy or an investment account, and you're wanting a second opinion to make sure that you're on the right track, that you're getting the most up-to-date advice, we're happy to complimentary just look at what you have and help you to either reassure you that, yep, you're on the right track, or, hey, you might want to look at these holes that we see in your coverage. But yeah, we're an independent firm that leads with New York Life, but we can service you with all of the top agencies out there.
So come on, give it up for Mark. Hey, man, let me tell you something, dude. I am so happy because this is a goal that I had back in 1989. I wrote down on a piece of paper. You know, like when you write your goals and you want to like achieve all. Like I'm living a jet life, so I got a jet. I got a house in every city that I like to live in. I'm not working for need. I'm working off the return on my investments. My last goal on that list was to help at least one family every year get on the right track. And I remember contemplating, like, should I just say one? I'm just going to say one because I don't want to overstate my goal because I might be too busy, living a jet life. And so when you fast forward and look at what we're doing now, we have 21,000 subscribers on YouTube. So I want to thank you, Mark. I want to thank you for being part of that goal that I had in 1989, just helping one family. I think we're helping thousands now. So thank you. Give it up for yourselves. So before we say goodbye to our online audience, on the third Saturday of every month for 15 years, we've been somewhere in Dallas live streaming and recording and putting on YouTube our program. Our next program is going to be October 18th. It's going to be on estate planning. So put that in your calendar. Stay connected with the Empower series. This is not the end. This is the what? Beginning of a relationship. Stay connected. If you have any questions, you can email me at thrive@empowerseries.com. I just put on the chat, if you want to make a donation, since we are a 501c3 nonprofit organization, on YouTube, which is great, they have this thing called YouTube Giving, where you can make a donation on live chat or on any of our videos that are fundraisers, and YouTube would not charge us a fee. All that money goes directly to us. That's great. Or you can text, give, or donate to 214-225-6337 or go to our website, empowerseries.com. Anyway, but I would say first, get what you're supposed to get from the Empower series. Empower your life. Do that. Share it with somebody else, and then let us know how we've transformed your life. And then you can always give of your time, your in-talent skills, or your treasures. So again, thank you again. Thank you, Mark. We're still going to be here for a little bit, but for online audience, share this video with someone else. Don't keep it to yourself. Don't be a gatekeeper. And I look forward to seeing you again. If you have any comments or any questions, please email me, and I want to thank you and let you know that I love you.